By the time a suburb is called hot, most of the growth has already gone, which begs the question, how do some investors consistently get in early, before the headlines, before the hype, before everyone else? And it comes down to something that most people never look at, the invisible numbers. And this matters because if you're going to use the same data as everyone else, you can get the same average results as everyone else. Or worse, you end up buying into a market that's already peaked, and no wonder why nothing's moving. I'm Corey Jones, and I've helped hundreds of everyday Australians generate over $100 billion in equity in the last 5 years, just by getting into the markets before they have a run. Now today, I'm going to break down the 7 invisible data signs that we actually use to find growth suburbs early, so you can start positioning ahead of the market, not just chasing it. Starting with number 1. Why most investors are too late. See, most people typically rely on median growth charts, top suburb list, hotspot list, news headlines, or past performance. Now the reality is, guys, if you're using the same data as everyone else, you can get the same results. Average at best. So what should you be looking at? Now, this is what I call the invisible data. And these are signals, all online, all easy accessible, that you can have a look at. Starting off with the first one, days on market. Now, the more property that you have and the faster that they sell, that always equals to rising demand. Now, what that means, if you've got an area and the days on market are substantially lower than the surrounding areas, it means that people want this area more than surrounding areas. That fundamentally, guys, is demand. Now, keep in mind, speed changes before price does. Number 2 could be transaction volume. This is one that translates directly into buy demand as well. The more volumes in that suburb, the more likely you're going to start seeing price rises in that suburb. All right, so transaction volumes is key. Number 3 is the total stock on market. That's supply levels. Now, having declining listings, that means you're going to have tightening supply. It creates upward pressure on prices, but keep in mind, guys, the supply is always in relation to demand at a state and a local government level. All right, so as an example, if you've got an area that you're really looking at, seriously, and it's got 10 houses for sale, and the state population growth is 10 people, you've got an oversupply. Because the 10 houses in that suburb versus the 10 people coming here with that one suburb, you've got an oversupply because there's probably many other suburbs to choose from just outside of that suburb. Now, at the same time, if you've got 10 areas in that suburb for sale, but the state population has grown by 10,000 people, we now have an undersupply. So it's always in relation to demand. When supply disappears, prices do not stay still for long. Number 4, rental pressure indicators. So vacancy rates is a big one. Percentage of investors, rents rising quickly, or rising quickly rather. Now what that means is when we see population surges in an area, that generally signals there's going to be a price rise. It also attracts investors, right? It funds their growth cycle. It funds the cash flow coming into that portfolio. If they can see the numbers, the rental numbers increasing, demand is going to quickly follow. Infrastructure timing, and not just announcements. What's actually funded, what's actually underway at a federal, state, and local government level. And not just what's proposed. We've got to focus on completion dates. An announcement doesn't move the market. The delivery is what moves the market. Migration and population flows at a micro level. Where are people moving throughout the country? Where are the lifestyle shifts? Keep in mind, guys, most people who are coming here from overseas are coming from places like Asia, Africa, the Middle East, Europe. Keep in mind, when they come here, they can only move to where is affordable. That doesn't mean we just go to the cheapest locations. Pay very mindful attention to what areas are on the more affordable side. Number 7, building approvals and construction slowdowns. So when we think about building approvals, this is on the ABS data, looking at what the future pipeline is coming in for the supply. Notice the future supply constraints. This is incredibly important in Australia right now, with obviously all the variability when it comes to trades and materials, and obviously building prices. None of these on their own guarantee growth. But when you've got multiple signs like this that align, this is where the real opportunities are. Now, I also want to help you guys learn on how to use this data. This is where you separate yourselves from the data nerds and show some practical intelligence. Now, firstly, when we start combining these signals and not just relying on one metric, but on a spread of metrics, you're going to start seeing some patterns, and these patterns are going to start stacking together. Now, timing matters more than picking the best area. Now, to be clear, there is no such thing as a perfect area or perfect property. Those just don't exist. It's an illusion. But a good area in the wrong time can still underperform. An average area at the right time can outperform. All right, so timing is key. And then when we've got to consider the strategy versus the suburb, the strategy is always so much more important. In fact, one of the things that I always hear from our clients or from people out there, hey Corey, I know you're the property guy. I want to buy a house. What sort of house should I buy? Where should I buy it? One of the most irrelevant questions you could possibly pose. Why? Your strategy is what dictates what property and where. It's your strategy that builds your wealth, not the property. The same suburb may suit one investor, but not another. It depends on your borrowing capacity, goals, risk tolerance, a number of other factors. Most investors, guys, don't just chase growth. They consistently position themselves to continue moving. That is the key here. Now, here are some questions you could probably ask yourself. Are you looking at the leading indicators or just past performance? Past performance is important, guys, but I don't care what it's done in the last 5 years. If I'm about to buy it, I want to know what it's going to do for the next 5 years. Another question you can pose. Do you know what's actually happening in the market right now, not just 6 months ago? Now, if you're looking at a suburb because it's trending online, do you understand it's too late for that suburb? Yeah, as an example, on social media, we see all the time ads being advertised by different property gurus. This is the latest hotspot. That's the latest hotspot. Why? Because it's received 20% property growth. And therefore, people see that 20% and then want to go and buy in that suburb. Don't. You've missed it. You wanted to buy in that suburb 3 years before that. So you're the one getting the growth, not buying at the top of the market. Now, this is the kind of data that most investors never see or don't know how to interpret. Now, if you want some help identifying where the next opportunities are or what's happening right now, feel free to reach out to us. More than happy to help.